Hey guys, how's it going? Welcome again to Real Talk Real Estate Straight Up. My name is Dave.
I'm Steve.
And this is Steve. And today we want to talk to you about something that a lot of people don't know you can do, but can actually save you a lot of money on closing.
Wow. Wow, Dave. A lot of money could be saved here.
So today we want to talk about how to save money when you're buying a house. It's really expensive. There's a lot of closing fees, but there's one trick that a lot of people don't know about that you can use to save tons of money.
Now, this trick won't apply to all of you. It might apply to only some of you, but it's always a good thing to know. All right? So this applies to people that buy with less than 20% down, because when you do that, you actually have to purchase mortgage insurance.
Okay, so the law in Canada is if you're buying a property with less than 20% down payment, you have to pay mortgage insurance.
Absolutely. So there are only 3 insurance companies that provide those mortgage insurances. But here's the trick. Here's what people don't know. That's where the money is. This is where you got to listen. When you purchase your property with less than 20% down, you pay that premium, the mortgage insurance. Now it's incorporated onto your mortgage. So I'll give you an example. If you're taking a mortgage for $300,000, your insurance premium would be roughly $10,000, right?
Right.
Now that's about $10,000 over the life of the mortgage. So if you took a mortgage for 25 years,
which is the standard,
that would be your premium for that 25-year period. Right.
So what you're telling us is that when you're buying the mortgage insurance, you're not buying it for the mortgage term. You're buying it for the whole lifetime
for
of the
the
mortgage.
whole longevity of that mortgage for 25 years, right? Now, when you got that mortgage funded, that's what you paid. Now, Dave, let me ask you a question. A lot of people, what do they do when they sell their house and buy another house?
Well, they close their mortgage and they close their mortgage insurance.
Absolutely. So it's done seamlessly. People don't even know what happens. It's magic. You go to your lawyer, you sign the sale, you sign the purchase, done. What happens in the background is that this insurance policy gets paid off, and then supposedly if you're buying another house with less than 20%
down again, yeah.
You're buying another insurance policy. Now see what happens. You owned the house for, let's say, 3 years. Then you sold it. Then you bought another house. So off that 25-year policy, you've only actually used 3 years of that $10,000 premium. But
Right.
what happened at the sale? You paid it off completely. Nobody tells you this, but you paid off that entire policy completely, and then you purchased another policy for another property. So what happens is you actually use, let's say, $1,000 out of the, or $500 out of that $10,000 policy.
Right.
There are no refunds on it, and if you pay it off, it's done.
Okay.
The money is gone, poof, and then you purchase another policy.
So these mortgage insurances, they're transferable to different properties.
So ideally, yes, they are transferable to different properties. The only thing that you have to do is you have to ask your mortgage broker. If you're using a different broker, then go back to your lawyer who did the first closing for you and find out what's your policy number. The only thing your mortgage broker has to do is just use that policy number when they're applying for the new mortgage. You might have to top that off, right? So if you borrowed $300,000, now you're borrowing $400,000. Of course, there's a difference. You're not going to get any money back out of them. So if you're borrowing less, you're not getting a credit. But if you are borrowing more, you just have to pay the top-up difference.
But still, it's a lot less than what you would originally.
But it's a lot less. It's a lot less. So if you had 300, now you're borrowing 350. So you're going to fill in the blank, sort of another few hundred, maybe $1,000. But you don't have to pay off one policy to only then purchase another.
Okay, so when I'm selling my house, I have to close the mortgage, but I don't have to close the mortgage insurance. I can just get the policy number and use that same policy on the new property.
Correct.
But if I got a bigger mortgage, I just might top it off.
Exactly, for whatever the difference is.
So what's happening here is you're not paying twice for that mortgage insurance.
Absolutely,
right.
Absolutely, Dave. This is, wow, the amount of money this is saving people is insane, and the amount of money that CMHC makes off of people paying off their premiums and they're getting into another one it's amazing.
Right.
It's amazing. They're basically getting the same money that they are supposed to receive over 25 years. They're getting over 3, 4, 5 years The average home sells over 3 to 5 years.
Right, yeah.
Insane.
All right, cool. Well, this is how you can save money on selling a house or when you buy a new house. It's all about the mortgage insurance.
Save thousands.
Hope you guys
Subscribe.
liked it. Please subscribe and like our Facebook page. Thanks. Bye.